Afternoon, everyone, or good morning, good evening, wherever you are. Thank you all for being here, and thank you to the organizers for giving us this opportunity to present our work. So this paper is joint work with Adam Farago and Ornthanalai, who are both here, and I'm happy that they are. So index options, in particular, put index option, they play an important role in the economy. And there has been extensive research devoted to understanding pricing puzzles in this market. So actually, Dima was a little bit wrong in his introduction because our goal here will be different. We will focus mainly on quantities of put options that are traded in equilibrium, and we will do this within a model that features two asymmetries, and hence the title, one in preferences and another one in fundamentals. Okay, so my plan for today is the following. I will start with a quick introduction to motivate the topic, and then follow up with a few facts that are just meant to give us an idea about this market, the extent and the nature of index options traded in the data. And after that, a brief summary of the model and the main results. I promised that when discussing the theoretical part, I will go very easy on formulas and try to convey the main intuition using figures instead. And fingers crossed, I hope it works. So in terms of motivation, where are we coming from? So why do we need a model? Because this will be a largely theoretical investigation. Why do we need a model that explains a put option market, and don't we have one already? So let me start with discussing a number of stylized facts that you see listed here, and then hopefully convince you that there is actually a need for theoretical basis that helps us understand all these facts taken together. So first of all, this put option market, the index market for puts, is quite large economically in terms of a notional value and its potential to transfer risk. So I will actually be a little bit more precise, and I will show you some stats here. But on an average trade date, the number of shares, S&P 500 shares referenced by SPX putting index options, is about 10% of the total equity of the market. Okay, so with the market cap of the index being around 33 trillion, this amounts to more than $3 trillion of the index value, right, of the underlying index that's controlled by these positions. Second, buying index put options, and this is what Dima referred to, has been shown to have highly negative expected returns. And this negative risk premium for these type of products is not surprising, but the size of the premium has been referred to as a puzzle that is particularly challenging to address within the representative agent framework. So we'll be able to speak to that. But then again, pricing is not going to be our main focus. Then third fact is that public order flow in this market is dominated by buyers, and market makers on average are net short. It has also been shown in the literature that public investors can switch from being net buyers to being net sellers at times of economic distress. The fourth fact is about what we call the open interest curve. Across option moneyness, open interest peaks close to at the money contracts. And this is, again, something that I will also show you, but has been emphasized in these works here by Jude and Lyson and Bondarenko. And again, it's been puzzling for the models to explain. And finally, we have some new empirical evidence, and Dima here is part of this research that speaks about the connection between the trading activity in the put option market and the stock market, risk premium in particular. So, and interestingly, these two works that I have here on the slide, they find the opposite direction of this option stock relationship. So taken all together, and these facts are puzzling for the theoretical literature, because what we have in a partial equilibrium framework is that given these returns of, especially of the out of the money puts, risk-averse investors just choose to hold negative positions, right, with various degrees of risk aversion. And in general equilibrium, however, these options, well, they are in zero net supply. So somebody has to be willing to take the other side, right? Somebody has to be willing to hold put options despite the sellers achieving this high expected returns. So what do we have in general equilibrium? In a representative agent framework, well, there is no trade. So we can be successful in explaining prices, but we can't say anything about quantity supplied and demanded. If you consider a heterogeneous model, Then, of course, we have choices. Where does the heterogeneity come from? And so if we allow, for instance, different degrees of risk aversion, that doesn't help either. And we will show that. This will be the model that we benchmark ourselves. We do have some success with heterogeneous beliefs, okay? And I will speak to a paper by Borowski and Hiltzo that use the heterogeneous belief framework, and we can explain prices and demand, but we run into a problem when we try to understand the cross-section of the option market, because to generate large option demand, large option open interest for different moneyness, we will need a high belief dispersion about rare disaster risk, right? If we have these multiple options, a natural way to make them non-redundant is to have stochastic jumps. But when this is the case, so we have this high belief dispersion, and we need, and we have this high, basically heterogeneity across investors, we have a problem of matching the equity premium. So we can match the size of the market, but the equity premium will be low because of the risk sharing capacity available in the economy. Okay, so there's this tension here. So this is exactly where this paper comes in, because we will be showing that the size of the put option market, right? And here you can think either about the contracts, or the measure that I will be using is actually the fraction of index equivalent shares that are referenced by these options. The expansiveness of the put options, in particular in the low moneyness region, the shape of this open interest curve, what I said, that it peaks close to at the money, and the connection between the trading activity in the option market and the equity premium can all be rationalized with a model that features these two asymmetries: one asymmetry in preferences, which will be captured by disappointment aversion, and another asymmetry in fundamentals, which will be captured by the presence of tail risk. Okay, so and this last result in particular about the connection between the two markets, and I will show you some results about the cyclicality of the option market and the co-movement with the stock market. It naturally arises because shifts in what I will call market demographics, which will be just the wealth distribution between the two agents, they will be driving both prices and quantities in this model. Okay. So before I go in to discuss the relevant literature, let me just, for the people who are very familiar with options, but maybe not super familiar with the disappointment aversion, let me just very quickly visualize so that you have a picture in mind of this disappointment aversion utility. So this is basically a concave utility function with a kink at a reference point. And we have two important parameters, which I vary here on these different graphs. There is L, here on the left side, and there is kappa, which I vary on the right side. So what L will control, it will control the slope of the utility function below the kink. And what kappa will control, it will tell us where the kink actually happens. And these two graphs, this is just a bit of a terminology. So we refer to the DA, disappointment aversion utility, in the literature when the reference point or disappointment threshold is exactly equal to the certainty equivalent. And the GDA, generalized disappointment aversion, relaxes this assumption. Okay, so allows kappa to be less than 1. And I will be very precise about this a little bit later. But what we use is generalized disappointment aversion, but just for the brevity, I will keep saying disappointment aversion. So keep it in mind. And this kappa will actually play an important role in our contribution to the literature about these preferences. So I don't want to skip that slide. I know people often skip it, but I think it's important here to position ourselves. So disappointment aversion and these preferences, they have been successfully used in a number of settings. In a representative agent model to explain pricing, and as well as in the cross-section of asset returns to explain puzzles there. Our contribution to this literature is that, to the best of our knowledge, we are the first ones, this is the first attempt to study a heterogeneous agent model with these types of preferences. Then, in terms of option pricing and demand, the literature that's closest to the topic that we study, right? It's quite extensive, but as I already mentioned, so given the high expected returns, you get the result that the risk-averse investors want to sell these assets. And this paper by Dreesen and Manhout here that I have on the slide, they do actually consider disappointment aversion, and they conclude that it doesn't help because these agents, they choose to stay out of the market completely, Whereas we are going to show that this is only the case for this kappa parameter being equal to 1, which means that your reference point, your disappointment threshold is exactly equal to the certainty equivalent. So any drop in the wells below the certainty equivalent will constitute a disappointing outcome. Once you relax that, you get a lot of action in the option market. Now, in general equilibrium, there are a couple of important works that I want to mention. So there is Boraski and Yiltso paper that focuses on heterogeneous beliefs. We have a very different mechanism, right? And we don't run into this issue, this tension between the size of the option market and the equity premium that I mentioned earlier, okay? So in the work of Bates, this is probably the closest of ours, because what the paper studies is the equilibrium model with market crashes and different attitude to these crashes, heterogeneous preferences towards crash risk. However, the main emphasis is still on prices, okay? So we push this further, and we are going to talk about prices and quantities and the movement between different markets. In addition, the utility specification that's used in Bates is a little bit unusual in the literature, in the sense that the number of crashes enters directly into the investor's preferences. In our paper, we pursue the same idea, right, of crashes being important and investors having different attitudes to tail risk. But we will do this with the DA utility, disappointment averse utility, which is more conventional and has axiomatic foundations. Let me put it like that. And finally, let me just briefly mention this last paper that I have here, Konstantinidis and Leon, very recent work, and a very different paper, because it's a static model in which investors exogenously specialize into buying either out of the money or at the money puts, but not both. Whereas we will consider a fully dynamic framework without any restriction on investors' positions. So we'll see who endogenously arises as a buyer and the seller for what type of products. Okay, so let me preview the results here. I hope that I will be able to discuss all of them, but just to give you an idea of what we find. So I will refer to this economy that we study as DA plus array, because we will have one agent that's disappointment averse and one agent who's a regular risk averse agent, okay? So what we see is that there will be a sizable option market in this economy, and I will explain exactly why that happens and why disappointment aversion plays a big role. And this option market will signal shifts in the distribution of wells between the different types of agents. This market will also be hump shaped in this disappointment threshold, so that's a theoretical result that we will show. And so the shifts in wealth distribution between different agents will, of course, drive both the trading activity and the behavior of prices. And so we have here interesting predictions about the cross-section of the option market when we allow for options with multiple strikes. There will be predictions about the cyclicality of the demand itself, and also about the cyclicality of the price quantity relationship on the option market. And finally, the co-movement with the equity pricing moments, okay? I will briefly at the very end discuss pricing. As I said, the main focus will be on quantities. And so in terms of pricing, the most interesting implications are that we will have amplified stock volatility and large negative risk premia for out of the money options. Okay, so now I would like to go in and tell you a little bit what we see in the data. I mean, you probably know most of these things. This is just kind of using the most recent data that's available. So our sample period is from 1996 to 2020. And what we look at is at gross open interest for SPX options. And these are the dominant index option in this class that references the S&P 500. So what I plot here is basically historical data of this open interest in terms of percentage of index share. So each contract provides exposure to 100 units of the index. And what we do here, we would like to obtain a measure that's comparable to the numbers that we have in the model. So we report open interest. In the paper, you both see the number of contracts and the and index equivalent units. But in this picture on the slides, it's as a fraction of S&P 500 shares. So what these shares are just basically computed as market cap of the index divided by the level of the index. And it's actually stable in time. So you can see that the number of contracts doesn't really change. Reporting this in terms of the number of contracts doesn't really change the what you see, right, in terms of the time series. So what we have here is the daily open interest average over each quarter, right, from 1996 to 2020. And I want you to note 3 things. So first of all, it has increased dramatically, right, over the sample, more than 14 times. And the demand for index puts is substantially larger than that for index calls, okay? And that's partly the reason why we want to focus on puts. And in terms of the index shares that are referenced or controlled by these options, I mean, you see that this is an economically large market, right? So total around, in the recent years, it's around 20% of index shares that are controlled or referenced by these products, okay? So now I will quickly zoom in into puts and calls separately across moneyness and maturity. And so what I want to emphasize here is that we see that the highest demand, so you see here the 4 different squares show you the different maturities, right? And the different colors describe the moneyness. So what we see is that we have the highest demand for puts, and it actually concentrates in the short-term out of the money positions. Okay, that's kind of the point here. And once again, these products will be the main focus on the paper. If you take the same, if you kind of remember the scale here, that it goes from 0 to 5%, and if you look at the puts here on the next slide, you see that the numbers are much lower. And in terms of, sorry, if you look at calls, the numbers are much lower. And the demand concentrates more for the at the money and the out of the money positions. Okay, so the last data graph, the last kind of motivation that will be important for what we want to show in the model is this open interest curve. Okay, open interest across moneyness. So in contrast with the pictures that I showed you before, the time series ones, this is a cross-sectional view of the demand for these SPX options across a finer spectrum of moneyness. And what you see here is that for both calls and puts, the puts are the darker bars and the calls are the lighter ones, you see that the demand peaks, so this open interest peaks when the contracts become close to at the money. And this is consistent with the findings in the literature that I mentioned before, the paper by Oleg Bondarenko and Juden Lyson, they find a similar fact. And this is a puzzling observation that hasn't really been explained theoretically. And once again, for puts, if you look at puts, we still observe this asymmetric pattern, right, where most of the demand is in out of the money put together with the peak close to at the money. Okay, so this is sort of the empirical part about the nature and the nature and the character of the demand for these products in the economy. Now let me go forward and speak about the model. So it will be a heterogeneous agent economy that we study over finite horizon. And in terms of the, I will actually show you results for 2 types of economies. So the main one will be the disappointment averse agent and the risk averse agent, right, interacting together. But to benchmark ourselves and to understand where exactly the results are coming from, we will also consider a benchmark economy with 2 agents that are both risk averse and have heterogeneous degrees of risk aversion. Just for the purposes of kind of understanding the graphs, agent A will always be the disappointment averse agent, while the agent B will always be the risk averse. And then if you compare to the 2 array case, agent A will be the one that has higher degree of risk aversion. So A is always the one that dislikes risk. In terms of investment opportunity set, so we'll have a market with a stock, an option on the stock, and the riskless bond. And I will relax this later when I would like to study multiple derivatives. The stock will be a claim on the terminal dividend at time capital T, and we will have this publicly observable dividend news process that follows basically a GBM with a jump, right? So I will start with one jump. So this is the first asymmetry, right? The asymmetry in the dividend fundamental, and then I will relax this in order to have multiple derivative products being non-redundant, we will need to relax this and allow for stochastic jumps. For now, this is just one negative jump. So we have crash risk in the economy. And in terms of the shares of the two agents, so at time 0, we will assume that A is endowed with fraction alpha of the stock, and agent B is endowed with fraction 1 minus alpha. So this is in terms of the market that we have. And in terms of investors, so we will use this disappointment of ours.
Can I jump in and ask a clarifying question?
Yeah.
On the previous slide, so there's only one option available for trading?
Yes, here we only need one option to complete the market because we have Poisson jumps with constant intensity and constant jump size, right? So one option is enough to complete the market. But if I want to study the options across moneyness, what I'll introduce is stochastic jump sizes, and then multiple options will be needed to.
So one option is enough to complete the market. So then are then investors going to construct different payoffs by dynamic trading?
Exactly. Yeah.
Okay.
Exactly. And I will show you what happens if you take out that option. I mean, exactly, your intuition right. So there's going to be dynamic trading, and I will show you the wealth profiles of these different options and of these different agents. And yes, they will need, in order to be able to construct those, they will need the one option in this case. But if there are multiple sources of jump risk, then multiple options will become non-redundant. Yeah, does that?
Yes, thank you.
Does that answer? So in terms of preferences, we will have this GDA, generalized disappointment aversion. So as I showed you, it's just a kinked utility function. But importantly, this kink is tied to this, so it's not exogenous, right? It's tied to the certainty equivalent of the investor's final wealth. And really the two parameters that are important here that I highlight, and this is exactly the second asymmetry, right, that we need. The two parameters are, again, the L and the kappa. So the L will control the degree of the kink, or the slope of the function below the kink, and kappa will control the location of this utility kink. And so this kappa is also called like GDA multiplier, and we will assume that if it's 1, then we have the kind of the classic Gould 1991 disappointment averse utility, but if it's less than 1, then we have the generalized disappointment aversion preferences. So yes, and you see here the theta is the disappointment. Let me actually write here. Theta is the disappointment threshold, and it will depend on the certainty equivalent, and the kappa will control exactly where the kink happens. So
while we're on the slide, there's a question from Christian. So presumably the results are going to be sensitive to the value of alpha, the initial proportion of DA investors?
Yes and yes and no. Yes, of course they will be, and I will show you a lot about what changes exactly. Like you will have completely different economies in a sense, right, depending on who owns higher proportion of agents in the economy. And of course it's also natural that, so alpha is the initial proportion, but as you let the economy run, right, and you start with the initial dividend, and then the dividend use changes, the relative proportion of the agents will change as well. Right, so this will also be important, because as you get into better states or worse states, who controls the economy, who owns the higher fraction will change, and the option market will react to that, and the risk premium and everything. So yes, and I will show you those graphs across alpha. This is a very good point. Yeah.
All right, he had another question, but your co-author answered it, it looks like, so that's fine.
Okay,
so please,
awesome.
please carry on.
This is so great about the online seminars. You get all the help you need. So this is just briefly that, I mean, we're not doing anything strange. People, investors optimize, and we have market clearing. I just want here to kind of give a nod to Bamber and Uppal paper, because to solve for the benchmark economy with heterogeneous risk averse agents, this is not really trivial, and we were happy that we could use the results and didn't really have to resolve that model. In terms of our setting, I mean, we will use the standard methods, the martingale approach. Is just that for DA agent, it will involve a two-step procedure where we actually need to find, right, because the disappointment threshold is endogenous, so we will have a fixed point problem at some point. But these are just, you know, technicalities. Everything is in the paper. So let me go and show you here, which is basically kind of the core intuition that you should see already when I will talk about these equilibrium Wells profiles. So here we plot the equilibrium terminal wells of the two economies. So our main focus is on the plot on the left, right? But as a benchmark to see what's going on and what's different, we also plot the economy with the two risk-averse agents. So the y-axis shows you the terminal wells, the equilibrium terminal wells. The x-axis shows the level of the dividend fundamental, and we have the shaded PAF for reference so that you see which states are more or less likely. The blue line, so let me focus on the left plot here. So the blue line is the Wells profile of the disappointment averse agent, and the red line is the Wells profile of the risk averse agent. So looking at this plot on the left, we see that what will happen in this economy are all the states of the world will be endogenously classified into three groups. There will be bad states, intermediate states, and good states, as we label them. So intermediate states is where you see this flat profile that the disappointment agent would like to achieve. So disappointment averse agent would like to keep his wells constant exactly at the disappointment threshold, which was this theta that I showed you before, in order to avoid disappointing outcomes. And this can only be achieved if the risk averse investor is willing to accept the wells profile that pays the difference, right? And here's the difference between the terminal wells, because right now we are at the end of the model, right, at time capital T. So for the risk averse, the profile in this middle region is just the difference between the dividend, the terminal dividend, and this theta. What happens in the bad states is that you see that the Wells profile of the DA agent goes down. So here, disappointment averse investor has to accept the disappointing outcomes because these are just very expensive states to insure against. And then in good states, so to the right of the graph, right, in terms of dividend being above 1, we see that the risk-averse agent attains a relatively higher final wells in return for providing insurance to the disappointment-averse guy. So if you contrast this with the plot on the right we have the benchmark economy with two risk-averse agents, and we see that what we see here in terms of profiles is that for the more risk-averse agent, the profile is the payoff is higher in bad states, and the profile is slightly concave. The less risk-averse agent enjoys larger payoff in good states, and the profile is well, it's almost linear but slightly convex in the dividend payoff. So the important difference between these two economies is exactly the presence of this flat region on the left plot. This will drive everything in the model, because this is exactly why there will be a sizable demand for put protection in such economy, because the DA agent, disappointment averse agent, wants to achieve this Wells profile with the available securities. And you can think of it as the fully insured region, right? How wide it is, that will of course depend on these L and kappa parameters. Okay, so the wider it is, and also where it is relative to the distribution of the dividend, this will drive the amount of options demanded and supplied in the economy. In this particular case, we have L equal to 2. So for reference, the literature uses even higher numbers, 3 and more. And kappa is equal to 0.98, which means that a 2% drop in terminal wells compared to the certainty equivalent, it constitutes a disappointing outcome. And we see that basically in this situation, the disappointment averse agent is able to pretty much fully insure herself, right, against disappointment with probability almost close to 1. Because if you look at the density of the terminal dividend, you see that the states of the world that are endogenously classified, they are in a way, they are classified in a way that the largest probability mass is assigned to good states, the smaller probability to intermediate states, and then these bad states where he has to accept disappointing outcomes, they are probably practically 0 probability, right? So So in this case, he's able to fully insure. If we will have, for instance, kappa equal to 1, that what will happen, this flat region will become wide, and it will shift to basically cover almost all probable states in the economy, and the agent will, this is what has been shown in the literature, the agent will stay away from the risky markets completely, okay, and just invest all the wealth in the risk-free assets. So this is the kind of very upfront, the intuition where all the action will be coming from. And then I want to show you also the.
Let me jump in with an observation rather than a question.
Yeah.
Or you can feel free to react to it, of course. So I think this picture on the left is very interesting because back when you were giving your introduction, what I was thinking about was that a very large fraction of index options trades are spreads or combinations, right? And what's very interesting is the picture on the left looks like holding the underlying asset plus a vertical spread in puts. So you're actually explaining not just the quantity of put options, but also why agents would want to do complex trades, or at least here why agents would want to do a vertical spread.
Yeah, this is a perfect observation because as I'll show you, right? So what the agent will try to do is to achieve that profile, right, with the available securities. And so what we will be throwing to the agent in this model are put options and put options with different moneyness. But in terms of the risk exposure, right, and achieving this profile, if there will be an asset that helps to achieve it directly, right, without the combinations, then yes, this is where the demand will go. So this is a perfect observation, and this is exactly in line with what I'll show you later. For now, we don't focus on these products, but yes, there is a kind of endogenous demand for those. So in terms of, thank you, Neil. So in terms of the pricing kernel, here I plot basically three economies. So the blue line is the representative agent risk-averse economy. The red dotted line is the representative agent disappointment-averse economy. And the green one in the middle is our economy with the two agents. So let's start with the two polar cases first, and then I'll discuss what pertains to our model. So here, when you have only the risk-averse agent, this is the blue line, right, and corresponds to alpha 0, we get the standard CRA pricing kernel where the curvature is just determined by the risk aversion parameter. In the disappointment averse economy, where it's just one agent, right, representative agent economy, the state price density jumps at the disappointment threshold. And the size of this jump and the steeper slope to the left, right, after the jump, are determined by the degree of the utility kink, right, so this L parameter, and the location of the jump is determined by the kappa, right, the location of the utility kink. So finally, what we have in our model is basically, right, like I put it here, it bridges these two economies. So the green line is made up of three parts. They will be separated by this D under and D over that I showed you on the slide before. And the two important things that I would like you to notice is, first of all, there will be high level of the stochastic discount factor for low states, right, bad states. So this is again plotted, everything plotted against the dividend. So on the x-axis, I have the terminal dividend. This will give us high prices and low expected returns for assets that pay off in these states. So, you know, these low moneyness puts, I mean, the expensiveness of those will come out very naturally. And then the steep slope, especially in the middle part, will generate excess volatility in the model. So will amplify volatility, right? Because this basically tells you how prices will change when dividend moves around. So now, the last thing, kind of before I go on and really show you finally the option demands, is I would like to talk about risk exposures. Because again, this is one more step that will help to understand where everything is coming from. So here we would like to illustrate the equilibrium wells. In this case, it's time zero wells, but you get a similar picture for any intermediate point in time. And risk factor exposures. So what do I mean by these risk factor exposures? Well, basically what I have highlighted here in red and green, the volatilities, right, of the wealth dynamics. And once again, I compare two models, our model on the left and the benchmark model with risk-averse agents on the right. So the solid blue line in all panels is the equilibrium balance of agent A, right? So remember, this was in our model, this is the disappointment averse guy. In the benchmark, this is the more risk averse guy. And the slope of the red line that you see here, let's focus first on the left plot. The slope of that line corresponds to the equilibrium exposure to diffusive risk normalized by the dividend news volatility, right? So it shows you basically how much, if you look at the slope, how much of diffusive risk that agent will tolerate. And the green line represents the equilibrium jump risk exposure. And it shows what happens in the event of a rare jump. So in this calibration, we have a 20% jump that happens once in 20 years. And you see that, of course, in equilibrium, in terms of desired exposures, when that happens, when we start with the point that you see on where the two vertical and the horizontal lines cross, you start from that point. And if jump happens the same instant, you, of course, end up still on the equilibrium wealth profile, but on this flat region. And so if you compare the slopes of these two lines, I know that what we see on the right is everything is sort of a little bit all together, because as I already said, the profile is concave, but here we look at the one horizon, right? So it's almost linear in this case. So all the lines are kind of all together. But what is happening is that if you compare the disappointment averse investor to the more risk averse investor in the other model, the disappointment averse investor is actually willing to accept a bit more of a diffusion risk, but is really averse naturally because of the preferences to the jump risk exposure. Okay, so and this is exactly where the demand, once again, of put options will come from, because if you look at the suboptimal case, so here I took away the option and look at the alternative scenario, right, which demonstrates what happens if agents only can invest in the bond and the stock. And simply for illustration here, I assume that the exposure to Brownian risk remains the same, and this just simply will allow us to pin down the investment in the stock.
So let me jump in. There was an old question that I neglected to ask because I was talking myself. But anyway, from Binghan, why is the wealth of the RA not much higher than DA in good states? Or is that correct?
No, it is. So it's about this graph. It's true. It's not much higher. But if you look at the distribution at the same time, so these are much more likely states to occur, right? So in terms of, I mean, if you think about the in expectation, right, and the mass of these states, and compare it to, indeed, you see that for example, in the intermediate, the blue line is much higher than the red one, but these are very, very unlikely states, right? So kind of it's also natural because the risk averse agent collects the premium, right, from selling the put options, and the disappointment averse agent in these intermediate and bad states, when options get exercised, gets a big payoff. But just think about the difference between these lines in connection with the density, right? So if you think about the chances of occurrence of these states in expectation, like the two actually make sense. The two are relatively similar. So it looks like a small difference, and the other looks like a big difference, but they're very comparable. Okay?
So another question is from Dima, but I'll kind of rephrase it, right? So the RA agent is selling the options here, right?
Yep. And I haven't shown you this yet, right? I haven't really. What I need for these pictures is for the market to be complete. I don't really need to specify what it needs to be completed with. So I haven't really shown you the option demand.
Right,
but
right.
yes,
so he's synthetically selling options. You really don't care what the two securities are, right?
Exactly. Yeah.
And okay, and because he has power utility, he never enters into a set of positions that would cause him to default on his obligations?
Nope. No.
Okay.
we don't have default in this setting, right? Adam, you can.
And it's because he never wants
correct.
to. Right? Because of his preferences, he never wants to enter into that set of
No,
trades.
and because remember these states, I mean, they're not exogenous, right? They're endogenously classified. So nobody, like the array will not default in this model. And I mean, it has to do how basically these regions are actually determined, right? They're determined according to the preferences of the two agents.
All right.
I
Why
hope
don't you carry on?
that answers it.
I'll let him follow up later.
Okay, that sounds good. So what I want to show you here, and let me just finally go after this to the option market, right? But what I want to show you here is that if you take away the option, what happens on the left graph is that in the event of the jump, the disappointment averse agent was is really, really below the optimal level. Okay, so to hedge this risk, to get back on the flat profile, that agent would really like to buy a put option, right, which would serve as an insurance when jump occurs. Whereas if you look on the graph on the right, it's a little bit curious because what you see first is the deviation from the optimal profile is actually minimal. Okay, so that speaks to already to the fact that we should expect a very, very small market, if anything, in this benchmark economy. And another curious observation, which at first seems a bit counterintuitive, but it's actually in line with the literature, is that the more risk-averse agent here would actually like to sell, right? You see that the green line is above the wealth profile, and to get back on the wealth profile, the more risk-averse agent would like to sell, and the option to the less risk-averse agent. So let me just briefly comment on what's going on here, because we'll see some similar strange selling behavior in our model as well. So the way you should think about it is that you have these investors who are trying to achieve these desired exposures to both types of risks, okay? And different risky assets, they offer different exposures to these risks in different proportions. So what the stock will provide almost equal exposure to both, to the diffusive and the jump risk in the dividend fundamental. So the more risk-averse agent here in this benchmark economy wants to avoid diffusion risk, but can tolerate a bit of a jump risk compared to the disappointment averse on the left. So what will happen is that he will actually end up investing considerably less in the stock and just sell a little bit of the put option to bump up slightly his exposure to jump risk to the optimal level. So if you think about the total exposure to risks from this strategy, it will still be lower than that of the less risk-averse guy. Okay, so we don't have a counterintuitive result that the more risk-averse agent takes more risk. No, not at all. It's just in terms of the optimal exposures, the more risk-averse agent will be selling a small quantity because he can tolerate a little bit more of the jump risk than the stock alone provides. Okay, so this is basically tells you why we get everything that I will show you next. So the next, I will just show you these model implied results for put options and speak about pricing at the end. So in terms of the size of the put option market, so these two figures show the number of options demanded in our economy on the left and the benchmark economy on the right. And the y-axis, I mean, here it's the number of shares that the agent will demand, but we have a unit net supply of the stock. So you can interpret it as in terms of the fraction of index shares, right, that I showed you in the data. And the x-axis is exactly, I think it was Christian asked, so x-axis shows exactly the proportion of the D agent versus to the array agent in our economy in terms of initial relative wealth. We get a very similar picture if we do it for a relative wealth at any point in time that's not zero, right? If you move the economy a little bit later. So once again, by using these available assets, the agent invests in the two risks according to the desired exposures. And so the derivative that we consider here is this 1 month out of the money put option. So when you look at the low values, if you focus first on the left graph, so first of all, we see this hump shape here. And so for the low value of the x-axis, the DH agent has little wealth, right? So the number of put contracts in equilibrium is relatively low. But as the proportion increases, we see the more demand for put protection. And when the DA agent owns a high fraction of wealth in the economy, so these are high values of the x, relatively high values, right, 0.5 and higher, then and you move more to the right, then the risk sharing capacity decreases, right? And the number of put options in the economy also decreases, right? Because there is less of the risk averse agent who is supplying these options. We also get a curious result, which is actually in line with what I showed you, the stylized facts in the data, that when the DA agents, so this is to the very, very right, like high value 0.8, 0.9 of the fraction of the disappointment averse agent, when he owns almost for all economy, you get the result that that agent starts selling put options, right? And this is kind of what we see in the data, that in bad times, in times of the stress, in times where the risk sharing capacity dries up, you observe this this switch.
So
why?
I'm a little bit puzzled here.
Yeah, tell me, Neil.
So here the primitive securities are the stock and a single put, right?
Yes, the out of the money.
And when you're talking about quantities, it's you're talking about the quantity of the primitive security.
Exactly, yes.
But the primitive securities could have been the stock and a call.
Yes.
So I'm thinking it might be hard, but an alternative way to think about the results, this is related to my earlier question, would be to look at the terminal wealth profiles and then interpret them as equivalent to a static portfolio of options, right? Because I think, here it's kind of arbitrary. I mean, the primitive security didn't have to be a put.
Exactly.
So.
But you see, I mean, everything I showed you before does not depend on what the security is. Okay?
But this interpretation of explaining the size of the put option market does depend on that.
Well, it does. I mean, we wanted to focus on puts because, I mean, since we have this downside risk, right? Puts, they provide greater protection on the downside, right, than say call writing. But I mean, if there is interest, let me put it like that. I mean, the model is completely flexible, right, into analyzing the demand for other types. So for instance, we will probably look at that in terms of the at the money peak for call options, right, which is also a puzzle. And so we can go there as well. So I could show you equivalent pictures, right, for different primitive securities, as you say. Our focus is on puts because we thought, I mean, this is interesting to understand, especially with the recent evidence about the put option market and the co-movement with the stock market. But as I say, so far, everything I showed you in terms of profiles and kind of the drivers of this economy didn't really depend on that. Now, yes, now I'm zooming in and talking about the puts.
So actually, I should shut up because I think you need to pay attention to the time.
Yes.
And I need to let you finish.
I will do that. So let me just briefly mention why we get the selling result. Well, what happens here is that if there are not enough risk averse agents, this flat part, the fully insured part of the wealth profile for the disappointment averse agent shrinks, and the profile becomes very similar to that of a more risk averse agent in our benchmark economy. Okay, in the benchmark, I mean, as expected, you see that there is a very small market, and it kind of goes the other way around. It seems counterintuitive due to the concavity of the utility function. Then that basically you don't get a sizable market, and the direction goes the wrong way. And this graph is just to show you that we didn't choose convenient parameters. So basically the graph on the left varies this level of disappointment aversion to the slope controlled by L. And for reference, L greater than 3 is used in the literature. And we see clearly here that as soon as L kind of increases, becomes higher than 1 and increases further, then the market basically stabilizes. So it's for sufficiently large values, it's no longer sensitive to these changes. And whereas when you look at the risk aversion, no matter how big we make this difference between the two risk averse agents, it doesn't help. We do not obtain a sizable option market in this benchmark economy. This result is the theoretical result that speaks to the disappointment aversion literature. It shows that what I outlined earlier, the hump shape of the market with respect to this kappa threshold. So when kappa is 1, you see that there's no market, because this is exactly where the agent is staying out of the market altogether. Basically, the flat region is so wide and it covers the whole distribution of the dividend, then investor chooses not to participate in risky markets altogether and just invest everything in the risk-free asset. Why do we have the hump shape? Why doesn't it just increase? Because when you have the low level of this kappa, it means that say more than 10% here, if it's 0.9, more than a 10% drop in terminal vals below the certainty equivalent is labeled as disappointing, okay? And this over 1 month horizon, it means that disappointment event becomes unlikely. And so there's simply no need to build a fully disappointment-proof portfolio. There will still be demand for put options here, but it kind of goes down slightly. So now the two things that we're most excited about, I guess, or I'm most excited about, I'll show you something about the cross-section and the dynamics. So here we extend our setup to from one option to multiple options. And again, here it will be still multiple put options. So in order for these options to be non-redundant, we allow for stochastic jump sizes. And in order to ground ourselves in the estimation of these jump parameters, we actually use the earnings data from Robert Schiller's website and estimate the parameters of the jump distribution. So what we observe here, what I show you here is 4 graphs. The axes are the same on all of them. We have open interest on the y-axis and we have moneyness on the x-axis. And it's just we go from 2 to 3, then to 4 options with different moneyness levels. And I also the y-axis on the right, sorry, shows implied volatility, so that we see what's happening with the implied volatility, and we see that we get a smirk here. So the takeaway from this is that we basically see that these patterns of open interest closely match what we see in the data. In all cases, we observe a peak close or exactly at the money. And if you compare the 2 bottom graphs where we have 4 options case, right, 4 jumps for options, note that when the moneyness of this option that's just out of the money but close to at the money moves from 0.95 to 0.97, when it moves closer to the at the money, the peak of the open interest curve actually shifts there. This is also in line with what we observe in the data, because in the data, I mean, of course, you have more of these moneyness buckets, and the peak is close to at the money, but not exactly there. So let me briefly outline the intuition for this. So the more options you have, the better you can disentangle all these simultaneous exposures to the diffusion and jump risk in the stock market. So to solve for these positions, I mean, you basically have a target, right? You want to achieve the desired exposure, which were these volatilities of your wealth profile, to all the risk factors, given the risk sensitivities of the traded assets, right? So with n risky assets, we have n equations with n unknowns, where basically each equation is, okay, here is my desired exposure. It's equal to the weighted sum of the exposures available on the market, right? The risk sensitivities, or you can think of them as deltas with respect to these different risks, where the weights are portfolio weights, okay? So the most intuitive is the 2 options case, because as you start increasing the number of options, I mean, you just get more equations and you get more lost. But let's talk about the 2 options case very briefly. So the disappointment aversion agent is long, both of these options, the at the money and the out of the money. And what explains basically the patterns, right? You see here that the peak is at the money on the very first graph, and the amount for out of the money is a little bit lower. So what happens here is that, once again, stock provides almost equal exposures to both of these risks. Out of the money put, on the other hand, is a great asset because it's very effective in carving out and providing the separate exposure to the negative jump risk. So you don't actually need to buy much, right? And I have it here on the slide, a little goes a long way. Whereas the at the money put, in terms of the relative exposures to the 2 jump risks, it actually happens to closely match the disappointment averse agent's wealth profile. So this is a very attractive asset. And this is exactly in line with what Neil said earlier, that if you were to provide an asset, right, that matches better, so not the puts, not the calls, but the asset that perfectly matches the wealth profile of the agent, this is exactly where the demand would be concentrated. Now, the last thing that I want to show you in the remaining 5 minutes is the option market dynamics. So what we plot here is the changes in, on the left side, it's the option demand, on the right side is the equity premium as a function of dividend fundamental. Okay, so this is kind of halfway through the economy at some point dt. The red and the blue line simply correspond to different values of the initial proportion of the disappointment averse versus to risk averse. So what you see here, let's talk about the equity premium first. It's and that's the plot on the right. It's naturally countercyclical, okay? And this is in line with the shape of the SDF I showed you earlier, and this is kind of very intuitive. But what we see on the plot on the left is that the cyclicality of the option market changes sign. So the hump shape is actually in line with what I showed you earlier as a function of alpha. But now this is more direct because it's a function of the dividend fundamental. So if you put these two together, it basically means that the co-movement between the stock and the option market can change sign depending on where you are, depending on the state of the economy. And so we argue that this result, that kind of the two put together, can potentially reconcile this at first seemingly contradicting findings that the recent research that I quoted obtained empirically, because we have one paper that shows positive predictability and another paper that shows negative predictability. And just very briefly, why we're obtaining this. Well, think about it. So in good states of the world, the risk averse agent wealth is higher because he was selling options in the previous period, and the DH agent actually lost the money because options never became in the money, were never exercised. So the wealth of this risk averse agent makes up a relatively larger fraction of the economy, and that's the supplier of these put options. Whereas the DA agent makes up a smaller part, and that's the demander, so it will be a buyer's market. And in this buyer's market, we will observe shocks to demand side dominating, and the market for put options will be countercyclical, and we will have a positive price quantity relationship on the option market. Whereas in periods of slowdown, the risk averse agent will start experiencing some losses from selling put options before some options become in the money. The agent gets wealthier, right? So now he makes up, so disappointment averse makes up a larger share of the economy. There is strong demand for put options by the disappointment averse agent, and the risk averse agent is more constrained in terms of his wealth. So this is a seller's market for put options or for crash insurance in general. And we will have the opposite effects. So we will have shocks to the supply side dominating and procyclicality and negative price quantity relationship on the option market. Okay, in the last minute, pricing. So here, what I would like to point out is that actually one asymmetry, crash risk, is enough to generate pricing implications. Because I mean, what you see on the left graph is, yes, we got a bit of a lower risk premium from out of the money options in our economy compared to the risk averse agent benchmark, which is the red line, and our economy is the blue line. But it's, the difference is not huge. And yes, maybe it will be important in out of the money, but for all the other moneyness, the DA preference don't really help. They only help with out of the money options. And also, when you look at the implied volatility, crash risk, this jump risk seems to be enough as well with the benchmark economy. So the point here is that crash risk crash risk alone is enough to generate pricing implications. But of course, as we've seen, it's crucial to have both asymmetries, so also symmetry and preferences when it comes to understanding quantities and prices jointly. Okay, and well, I would like to conclude. I mean, this is just putting together what I showed you in the preview before. In this economy with two asymmetries, we got a sizable option market that's in line with the size of it that we see in the data. We get the theoretical result about the hump shape. That's interesting. And this distribution of wealth and how it changes across states gives us interesting predictions about cyclicality of the put option demand, the co-movement with the equity market, and we can reconcile the evidence about the cross-section, right? When we allow for multiple options with multiple strikes to be traded at the same time. In terms of prices, I showed you, yes, we have larger risk premium for out of the money, but it's mainly due to the jump risk, and we have amplified stock volatility, which I didn't show you, but it's in the paper. And I'm right on time. Thank you very much for listening and for all the questions. And I'm happy to take more questions.
All right, thanks very much. So at this point, people are welcome to unmute themselves and use their microphones while you're to ask any question you want. While people are thinking about what questions they want to ask, I'll actually ask a couple of questions from the chat that I put off because of the time. So from Valery Polkovnichenko. So it is a bit unclear why with kappa equal 1, there is no demand. The DA is still second order risk averse. Why does he not insure against disappointment if necessary within the money puts?
Well, as showed you here, so in terms of this flat region, the flat region in this case, well, and we have the graph in the paper, if I'm not mistaken, it will be basically cover all the possibilities, all the states in the economy. And so in order to have a flat profile there for all the possible states, the only thing that that agent can do is just invest everything in the risk-free asset. Okay, because if he goes with the risky assets, I mean, he will have to accept other types of outcomes, either positive or negative. But in order to stay completely flat, he stays out of the market. So we have a graph addressing exactly this this question in the paper. It has to do with how wide that region is and where it is compared to the distribution of the fundamental.
Okay, a question from Steve Figluski. Your model has homogeneous expectations about stock returns, but different risk attitudes. Would a market with heterogeneous returns expectations, but similar risk attitudes yield the same results? If not, how would they differ?
Yeah, no, that's a great question. So, and this relates to what I mentioned earlier, if I understood correctly, right? We're talking about heterogeneous beliefs, heterogeneous expectations. So, we don't think so, right? That it would yield the same results. Why? And it has to do exactly with this tension between the size of the insurance market and the equity premium. So and it has to do with, especially with these results regarding the cross section and the dynamics, right? So the size of the put option market you can get, but when you start trying to explain multiple options trading at the same time, and also the co-movement between the two different markets. As I said, you run into this this problem that these are rare events, right? So and you would need a lot of disagreement about these rare events in order to generate a big enough market. But when you have a lot of disagreement, it means that there is a lot of risk sharing in the economy, and so the equity premium is low in those states, right? So this is kind of my intuition here about could you do exactly the same? And parts of it you could, right? But if you want to explain all these facts together, I really think that because it's not, I mean, we have a different mechanism here, right? It's really exactly the shape of this wealth profile, the fact that you have this flat region, and it's not quite like isomorphic to heterogeneous belief in you know, to the best of my knowledge.
Okay. Anyway, again, if anyone has any questions, feel free to, use your microphone and ask them, but I'll keep asking one or two more questions from the chat while we're waiting for that. From Bing Han, your model implies that the put option premium depends crucially on alpha. Is there empirical evidence about this? For example, think of alpha as the equity exposure of hedge funds?
That's a very good question, Bing, and we'll need to talk more about that. We actually wanted to talk to you more about that. Yes, so it becomes a little bit hard, and we thought about this, and this is an excellent idea, that it would be nice to try to pin down, because, I mean, we do get, the market becomes important very quickly as alpha increases, right? But how high does it need to be? So to pin this down empirically, I mean, I'm I'm happy that you have an idea here, because that would actually be really great. For now, we just show that, you know, as you vary it, it becomes important quickly, but to infer it from the data, that's not something that we have done so far.
Okay, last question from Bing, which I think is related. So I like how you try to explain both the quantity and price of index puts. Perhaps you can check the elasticity of put option demand with respect to price and compare it to the data. I think you've kind of already answered this, but anyway.
Yeah, no, that's a good suggestion. I mean, there are more things. So, I mean, we and now with Chay being on board, we're moving a little bit more to, you know, matching things to the data, and being a little bit more careful about the empirical part, the empirical content of what you're trying to say.
Okay, any other questions?
Yeah, hi, I've got Figluski here.
Hi.
Hi. 2 points. One is perhaps a quibble. You have a process for your dividends. My understanding of the model, if I've got it right, is that your D dividend thing is an expectational variable. It seems wrong to put it in with a potential drift of mu delta dt. So your drift ought to be zero if it's really, you know, the market's expectation about what terminal dividend is going to be, and you know how
No,
that.
I mean, it's just this. I mean, you can think of it, interpret it as the kind of the new. So it's not the pay. I mean, it's the process according to which the payout will be determined, right? So you kind of observe where it is. It's just you don't get paid that until time capital T. That's how you should think about it.
But if I got it right, the D should be the markets or the investors' expectation about what the terminal payoff is going to be, and that shouldn't drift.
Well, it's interesting because, I mean, we were thinking of actually matching it to like to earnings data, right? I mean, because this is kind of how you think of earnings. You know, you observe them, but you don't necessarily get them paid out until a certain moment. And then, I mean, if you do that, then I mean the mu will be non-zero. But it's an interesting observation.
It's a quibble at best. A quibble at best.
Yeah, I'll need to think about this. It's a curious point.
Another point, though, that I think is relevant, but not particularly to your model, only to the kind of option market information that you started with, that what we've seen over time is that the market has gone up. And I would argue probably that it's gone up more than was expected at the time. So what happens is there's a lot of options that are issued that are at the money, but as the market keeps going up, the calls are going deeper and deeper into the money, maybe getting liquidated, and the puts are going deeper and deeper out of the money. So there might be lots and lots of them, but nobody's ever going to bother to unwind them because they can't get anything for them. So it's kind of a messy kind of a discussion. But the point I'm making is that what the moneyness of the outstanding open interest of options and the quantities of puts and calls and so forth, that's somewhat endogenous to what the market has done.
Yeah, no, I fully agree. And that's exactly why we're trying to understand what will happen, I mean, theoretically with this market, if you look at different states of the world, right? That's exactly why we kind of go into this dynamics. What should we expect? Because of course, what we observe is one realization, right? Yes, things have been going well, so this is kind of what it is. But what we're trying to disentangle is, you know, like across these different states, what should we expect? So I mean, it's a valid point for sure.
It's not. It's really only a point having to do with how we interpret.
Yeah, exactly. No, I understand.
Call option, call open interest, put open interest, moneyness of the open interest of those two things, and so forth. That's all.